Now, I read an article the other day that Deutsche Bank, as you know, walking dead man of a bank, was giving anyone who's willing to put $10,000 or more into their account and leave it with Deutsche Bank for 3 months or something like that, would actually give them a 5% return. That is unheard of. Have you ever heard of a bank saying, give us 10,000 or more of your money, we'll give you 5% of it on it? We need it for like 3 months. You have to promise not to touch it for 3 months. Only a bank that is desperately needing some liquidity, some money, would do such an absurd thing. That's my take, and I've read something at Silver Doctors a few days ago, more like 2 days ago, that I definitely want to share with you. And the title is, Was Deutsche Bank Just Kicked Out of the Banksters Gentlemen's Club? Now remember, they're the ones that blew the whistle. Deutsche Bank blew the whistle on the gold and silver rigging, precious metals, and all of a sudden they're being treated like the redheaded stepchild, kind of. Now the interesting thing, because you'll read about them possibly going down with the ship with the massive derivatives on their books, but I thought that Citigroup and JP Morgan very recently were the ones buying a bunch of those derivatives from Deutsche Bank. So that doesn't quite make sense to me, but maybe there's certain derivatives they bought from Deutsche Bank and leaving Deutsche Bank with certain other derivatives that when it crashes will bring down certain entities. And maybe those other entities are different banks, not the too big to fails that we know so commonly. It says, is it possible the clan of monster derivatives banks is a very small club and Deutsche Bank ain't a member anymore because they turned rat? This certainly bears watching because if Deutsche Bank has been kicked out of the gentleman's club, they have been allowed to carry the red button kill switch called derivatives with them. Submitted by Bill Holter from JS Mindset, which is Jim Sinclair. For many years, we have warned of the dangers of derivatives. We were laughed at leading up to the 2008 financial debacle when Lehman broke and nearly took the entire system down. That turned out to be no laughing matter, and here we are again at exactly the same situation where derivatives threaten to melt the financial system again. The difference now, of course, is that saving ammunition has already been spent where sovereign treasuries and central banks have destroyed their own balance sheets. 2 weeks ago, the Fed announced a 48-hour stay-in-place provision for collateral of any derivative contracts that where the big banks are involved. The idea here is to prevent collateral being pulled out by the survivor for 48 hours should they bank counterparty become insolvent. This will give the Fed a window of time to get the fire hose, if you will, of liquidity out and reliquify a large bank's balance sheet before they can break the derivatives chain. But what does this really do? Does it make derivatives any more sound, or does it really just add more risk to central bank balance sheets and thus the currencies themselves? It is very important to understand just how important derivatives have become. Derivatives have been used to push, pull, manhandle, or outright price many global markets. They have been used to paint a picture of, as proof, the Alice in Wonderland markets are in fact real. Not even one single market can get out of control because truth anywhere will lead to truth everywhere. Even one single market left alone to Mother Nature will lead to questions that cannot logically be answered. First, these provisions being proposed by the Fed are not set to begin until August 2017. I cannot imagine markets holding together this long. In fact, I would give less than a 50-50 odds or whatever to the U.S. actually has an election this November, rigged or not. Next, and more importantly, the Fed is actually saying we will be the backstop to all of the derivatives given the 48-hour window to fix the problem at a specific bank. It does need to be pointed out, if any derivative of any size does fail, then someone somewhere is exposed. In reality, since few, if any, of the derivatives can actually perform, the entire world is swimming naked and already completely exposed. How can I say this? Forget about credit default swaps on something as unpayable as a U.S. default. Can the banks really pony up $300 billion, for example, if Greece were to fail? The real number is probably 10 times that amount, as the neighbors, if you will, are allowed to purchase insurance on their neighbor's home. That's what a credit default swap is. What better incentive to strike a match? Or what about another 10 times that amount if Italy defaulted? My point is this: everything everywhere is insured via derivatives. And again, these derivatives have their credit default swaps, which are essentially another kind of a derivative that's like an insurance product. Many markets and assets have more, or even many times over, insurance than the actual market has value. The coverage is simply unpayable. The only response to a breakdown of derivatives will be exactly what it has been, always has been: print more and more via QE or some other method. This is obviously destructive to currencies, as they will be diluted to zero. Whether you look at this picture from the micro standpoint of individual currency dilution, or from the macro standpoint of solvency, all roads ultimately lead to gold. Precious metals, how shocking is that? Real physical gold cannot be diluted, nor can it default. Gold will be viewed for exactly what it is. We have said gold will be the last man standing in a failure chain of fiat currencies. It will also be viewed as the only protective hedge in a world completely unhedged. As it stands right now, the belief is that everything is hedged. In reality, nothing is hedged. Once it becomes understood that no insurance anywhere has the ability to pay up, think AIG, it didn't have the ability to pay up, the world will collectively change insurance companies, if you know what I mean, and move toward the only one with the ability to pay. And as you know, that is precious metals, gold in this particular case. Switching gears, but I believe very connected to the above, what is to be made of Deutsche Bank offering 3-month accounts paying an annualized 5% interest rate? Liquidity problems? Deutsche Bank offers 5% yields if depositors lock up their money for 3 months. To state the obvious, Deutsche Bank needs money or liquidity badly, and they need it now. It's my liquidity, and I want it now. Think about this. Why would they do such a thing in a world where nearly a third of all debt carries a negative interest rate? Why didn't they go to the ECB's feeding trough and snort up some 0% funds? Or why didn't they just go to the marketplace and issue bills for 90 days at 0.25% or less? Why, he says. Unless Deutsche Bank is pulling some sort of late April Fool's joke, they obviously need money and are willing, or being forced, to pay 5%. Is it possible that they've been shut off, from the club? Please remember, Deutsche Bank pleaded criminally guilty to manipulating the gold and silver fixes. Part of their alleged settlement was turning states' evidence and aiding regulators in tracking down other perpetrators. Is it possible the clan of monster derivative banks is a very small club and Deutsche Bank ain't a member anymore because they turned rat? Other than not having access to capital anywhere else, I cannot think of any reason they would offer 5%. If this has become their only source of funding, then we just learned something very interesting. This number of 5% is the real and unsubsidized interest rate. Do you see the ramifications? The world has valued everything with a basic discount rate of 0%. What does it mean if rates or to raise real capital from the markets is 5% rather than free? Might stock markets be overvalued, and possibly real estate? Not to mention the foundation to everything, bonds? This certainly bears watching, because if Deutsche Bank has been kicked out of the gentleman's club, they have been allowed to carry the red button kill switch called derivatives with them. I am not really sure what to make of all this. Surely the powers that be would not kick the largest or second largest holder of derivatives off the reservation, would they? The only possible reason I can imagine is something has already blown up behind the scenes that is too big to be fixed or hidden. The blame for such a meltdown may very well be hoisted around Deutsche Bank's neck. To finish, please do not roll your eyes at this. If you have a logical explanation as to why Deutsche Bank would offer 500 basis points or 5% for 3-month money if they could get it cheaper elsewhere, I would love to hear it. Anyone who tells me Deutsche Bank is making this offer because they feel sorry for the elderly savers earning nothing on their life savings, will go into my spam box forever, he says. And I concur. There's not a chance in hell that any too big to fail bank feels bad for anybody. Oh, let's give them some good money finally. Again, all these big banks have had the ability to go directly to the Federal Reserve or the European Central Bank, the ECB, and basically say, give me billions upon billions of dollars at near or at zero interest rate so that I can then lend it out to these consumers, or useless eaters, if you will, and charge them several points of interest, right? I'll get it near zero, and I'm going to charge you 4 to 5%. They're not doing that. Why can't they go to the ECB or even the Fed and say, hey, give us some money? We're part of the club. We've always been part of the club. We've always had that ability. Why did that stop all of a sudden? Is it, like he said, the fact that they ratted out the silver and gold manipulation? They agreed, yep, we were the ones rigging it, and there might be some others. And if you take it easy on us, we'll give you some of those or all of those communications and emails and whatnot, and let the regulators and the investigators decide were there other culprits. Now, I mentioned before when I first heard about Deutsche Bank, getting into trouble, I said then, Deutsche Bank could be the bank chosen to take one for the team, for the club. And if they loaded up Deutsche Bank with all the derivatives, Deutsche Bank could go down with the whole ship. And the rest of the club banks say, hey, we don't have that big of a problem because Deutsche Bank essentially went down with all of them. The thing is, we don't know their holdings of derivatives like on a continual basis where I can go today and see what it is today and go tomorrow, right? We have to rely on data that's a little bit old to see who the big monster holders of derivatives are. And again, I do recall not that long ago, JP Morgan and Citigroup buying a big chunk from Deutsche Bank. So again, I would question that. If they're letting Deutsche Bank fail, or they're pissed off at Deutsche Bank for doing what they did, blowing the whistle on the gold and silver manipulation, and they're teaching Deutsche Bank a lesson, why then would JP Morgan and Citigroup take a bunch of derivatives off its hands? You'd want to flood it with more derivatives. I mean, would you not? But at the same time, why can't Deutsche Bank go to the ECB and just say, give us some more zero or negative interest rate money? It doesn't make sense. Now, negative interest rates, that could be the reason why. Because in order for them to borrow at negative means they have to pay. Right? When you have a negative interest rate, you are actually paying for it. So is that the reason? Because even though it's a tiny, tiny negative rate, you could still get all that money and then loan out a whole bunch of it to people. Or is it that there's not a whole bunch of people, at least with the proper credit rating left, to lend the money to anyways? Therefore, it doesn't matter. Even if the ECB did give it a bunch of money, it can't lend it out to make money with it. I just don't know. Don't have the answer. But I reckon we're going to find out in the near future. And I got a feeling that it ain't going to be good. Take care.